Okay, I want to welcome all of you to our first quarter webcast. We hope you're having a wonderful spring. Nick and I are going to do this webcast together today. Our colleague, Matt Underwood, is actually in Brazil on vacation. Goes to show the globalization of our society. So this will take about 20 minutes, and we'll give a brief overview of 1Q23. So let's get started. So you've seen this chart before. This is our, it shows the global market returns. And if you look for this first quarter, we had a nice rally. It really started late last fall, excuse me, and the market moved higher following a very difficult first 9 months of 2021. So we've continued higher in the first quarter with stocks being up about 7%. We also saw a big rally in the bond market. Bonds had a very difficult 2022. And so as the market has moved, interest rates have moved down. This quarter, we saw a big rally in bonds. If you look over the trailing 1 year, though, it's still been a very, very difficult period. And this encompasses a large part of the 2022 decline. So all of the major equity categories globally down for that 12-month period. We did enjoy a nice rally in growth stocks in the first quarter of this year. We're going to talk about this a little bit later on the webcast, but that's really been fueled by a very select number of high-tech, mega-cap technology stocks and a kind of a renewed focus on profitability of these companies. So this rally has been very thin. Only about 15 to 20 companies are contributing to that 7.5% S&P return and 14.4% for the Russell 1000 growth. And as we look down on the bottom of the page, one of the focus points of our dialogue with clients has been the difference between the Fed funds rate and the core PCE. That's the inflation rate. And if you look at the most recent quarter ending March 31, the Fed funds rate was at 4.83%. That reflects the last two 25 basis point Fed increases that occurred in February and mid-March. That number is now a little bit above the core PCE at 4.6%. That is the new inflation gauge that the Fed has referenced that they are trying to get lower and lower. So the ultimate goal is to bring that core PCE down to 2% and have the effective funds rate be 2.5%. But if you look a year ago, the Fed was way behind, and that's what caused the rapid increase in Fed rates. So today, at least, we're making progress. The rate's a little bit higher, and hopefully over time, we'll see both the Fed funds rate and the core PCE decline. The next page. This is just our scorecard. Some of you should be familiar with this. Our firm is always making active tilts and shifts, and they're based on our overall valuation methodology. And so in my 28 years of now being in the OCIO business, I can say in the last 3 years, it's the most amount of shifts we've made in our career. And it's because the market has been so dynamic and it demands that we do a lot of shifts. So this shows kind of the scorecard and our current positioning. And just as a reminder, if every asset class traded at fair value, then there would be no boxes on this, and that blue circle you see would be at neutral, would be straight down the middle, and therefore there would be no advantage to us making a tilt or a shift. But as you can see today, over time, the rectangular box that's shaded in blue, that represents how much we've done over the past 3 years, and where we are positioned today is the darker blue circle. And today we have continued tilts towards private markets versus public market equivalents. So these private markets cover credit, equity, and real assets. And over the last 12 months, private markets have outperformed public market equivalents by about 17%. So that's had a very strong positive return on client accounts. We continue to own very short duration bonds. So average maturity is kind of staying in that 6 to 1 year period. Capturing as much of the interest rate yield curve that's very elevated at the front end and a little bit lower at the lower end. We're kind of neutral on government bonds and credit. We don't really have an opinion on that, so we're neutral today. And coming into 2023, we actually started to add short duration high yield bonds. Last calendar year, we were in floating rate, which benefited significantly from the Fed hike cycle. These short-term high-yield bonds, depending on whether they're taxable or tax-exempt for high-net worth clients, we think offer very compelling risk return and income opportunities. So we're a little bit biased towards the high yield today. And then within equities, we have a modest tilt to non-U.S. a little bit of a tilt towards large cap, and the biggest tilt we have is value style versus growth. And that obviously, given growth had such a big quarter, that detracted from overall results a little bit. But as we go through this presentation, we feel very confident in our overweight to value. And then emerging was the only one of our categories that didn't outperform based on our bias. We have a very small overweight to emerging. This negative 9% number that you see on this chart, that's really reflected when Russia was removed from all of the indices after they invaded Ukraine. So Russian stocks fell sharply, about 70%, and they effectively were removed from the index. So it's not so much the underperformance of the broad markets, it's one of the biggest components of the emerging markets index was removed. And then finally, these buffered ETFs, which we introduced in early 2022 to client accounts. You'll recall they provide downside protection. The specific group we use provides the first 15% of market decline is protected, and then there's a cap of participation rate, which has been around 20%. So if you look across on our one-year impact, very significant excess performance from these strategic biases we made in the portfolio, and the only one that didn't work was the emerging markets, which once again had a very small overweight. So very proud of our global asset allocation work, and it's been a major, major contributor to excess performance in client accounts. And with that, I'll turn it over to Nick.
Thanks, Curt. So looking forward at the global market review, go over some fixed income metrics, equities, and just the kind of broader economy. So we're going to kick off here with what we're calling our chart of the quarter. This chart looks at the federal funds rate and also two separate sets of projections. So back here, just focusing on the blue line here, we see this is how the Fed funds rate has shifted over time. Big dramatic going to zero kind of right during COVID. And then starting early 2022, a real rapid increase. And as you recall, once the Fed kind of announced that they're going to take this aggressive stance, they was ready to kind of raise the Fed funds rate, we made a lot of these strategic bias shifts that Curt just described on the prior page. We added to private credit, private real assets. We moved shorter duration, putting the portfolio in a position to benefit from this and not be as impacted as we would have been in kind of a standard 60-40 or 70-30 portfolio. What's interesting looking forward are the projections. The Federal Reserve, they put out their predictions of each of the Fed chairs, what they expect the Fed funds rate to be over the next 12, 24, 36 and longer term. That's the gray line here. The Federal Reserve is telling us once again that they're going to continue to raise rates at least to kind of this 5.13% point. And that's why we continue to maintain our shorter duration posture, our private credit. Those, again, will benefit and not get impacted as much by any further rise in Fed funds rate. The Fed expects that to drop over time through the years to an eventual terminal rate of 2.5%. The market and what the market participants are hedging with interest rate futures is shown in green. You can see there's a big disconnect about what the market thinks are going to be the next moves here. So eventually, they all agree in the next couple of years, but there's going to be some volatility in the midterm because of these differences of opinions and positions that are in portfolios. Next, we look at the Treasury yield curve. This continues to be a very interesting chart. Going back to 2021, this is what we would call a normal yield curve. The longer maturities you had in your portfolio, the longer you lent to the U.S. government, the more you get paid, which makes a ton of sense. Coming into 2022, we look at the light blue line. This is what is called an inverted yield chart. The shorter duration or shorter maturity bonds were paying you just as much or more than what you would get if you had a 7 or 10 year locked up Treasury bond. There's been a little bit of a shift here in 2023. If you look at the dark blue line, the shorter end of the curve has even moved higher. So these bonds today are very attractive relative to the longer term. This is a temporary phenomenon caused by the Federal Reserve's aggressive policy. Their policy shifts affect this short end. Eventually, this will normalize. But for today, we like staying in the shorter duration position, tilted more towards this end. But as this curve starts to normalize, you can expect us to kind of shift back out. And this is something where one of our main areas of focus for the strategy team. When do we move out to kind of longer duration bonds to lock in kind of higher yields for a longer period of time? And on the municipal bond side of the equation, This doesn't really get impacted as much by what the Federal Reserve is doing. And what you can see, you kind of have a flat curve here between 3 and 1 year. But if you're willing to go out, if you have the time to go out longer with your maturities, you're getting paid increased yield, which is what you would expect to hold longer maturity municipal bonds. And just as a reminder, this green line, these are tax equivalent yields to kind of put them in an apples to apples situation comparison with the treasuries. This is one of those impacts of what the Federal Reserve did on the market. So coming into 2022, whether you had your money in just a savings or checking account, or if you had it in a money market fund, there really wasn't too much different in the interest rate that you're receiving. That's changed here dramatically. You can, by what's shown on the blue line, you can just invest in kind of a money market fund in a treasury and get about 4.6%, as opposed to what you can get in the savings account, which is only 40 basis points. This was a major cause of a lot of people that had significant size deposits, shifting those deposits from savings and bank and checking accounts into money market funds. This was a major contributor to what happened to Silicon Valley Bank. Silicon Valley Bank, they forecasted that their depositors would keep their money in their checking and savings accounts. So what Silicon Valley Bank did to increase, their profit, they went out to longer maturity bonds in order to get a spread between what they were paying depositors and what they were earning on the bonds. Once this happened, many people shifted from deposits to money market funds, causing Silicon Valley Bank to have to sell some of their longer maturity bonds at a loss, causing them, as we saw, to kind of go out of business. That shock that happened with Silicon Valley Bank and a couple other banks, the market was very nervous there for a few weeks, caused a very significant shift in the U.S. 2-year yield. Dropped from almost 5% to just under 4%. This is a sign that the market believes that some of what the Federal Reserve is trying to achieve with their monetary policy was achieved by Silicon Valley Bank going under, meaning there would be less liquidity in the market, and the market would it would be another factor that would slow down this market that we've had, just kind of runaway demand economy that we've had. So more layoffs, less spending, and that this kind of forecast also what we saw earlier in the Fed dot plot, that the expectation is over the next 2, 3, 4 years, interest rates will be lower. These are the two metrics we've been showing for a few quarters now on inflation. Curt went through this, so I'll be brief. CPI, the broad index, is this blue line. This is kind of all factors that make up the consumer price index across the United States. This continues to drop consistently all the way down to 5% after being, about 9% not too long ago. The PCE, which excludes food and energy, this is the Fed's metric. This one continues to improve, but improvements have been much slower here the last several months. This sits at 4.6%. The Fed is going to still continue with their policy and try to get this down to 2%. This is our equity risk premium chart. As a reminder, this shows the attractiveness of stocks relative to bonds, namely on this chart, the US 10-year Treasury. This relationship shown by the dotted blue line shifts over time. When stocks are very attractive, you could expect us to shift into stocks. When bonds are more attractive, we would shift into bonds. The interesting factor, which has now been 2 quarters back to back, this signal is currently negative, meaning it's a very, very small in favor of bonds today. So, we would need this to kind of continue to trickle down for us to kind of call everybody up and tell you we're going to make a shift in our bond allocation in portfolios. But it's, again, something we're monitoring as bonds have become meaningful in portfolios again and providing high yields. Looking at just equities here across the globe, this looks at the price to earnings ratio of US large cap, international developed, and international emerging stocks. So what you can see here, US markets got very expensive. This is when we started to shift away from just kind of a pure equity allocation, started investing in some private equity, starting investing in innovators. That US large cap sold off significantly in 2022 and it's bounced back a little bit, as Curt mentioned earlier, and a very narrow group of stocks have pulled the index higher here to start 2023. We still maintain a modest tilt to non-US equities. International developed is very strong so far through the first 3.5 months of the year. And emerging markets still kind of the most attractive, cheapest relative to this metric. And we continue to maintain an overweight to these two asset classes. Value and growth has had a wide divergence in their attractiveness over time. Again, this caused us to overweight value. Growth came down significantly, which was a big factor in our outperformance in 2022. It's bounced back up here a little bit, growth, but if you still look at the relative attractiveness of value, which is kind of right on its long-term average, versus growth, which is expensive, we continue to maintain that overweight to value stocks. And we see growth, even though it had a great first quarter, starting to show a little bit of weakness here so far in Q2.
One of the interesting phenomena that I referenced earlier in the presentation was this concentration of these mega cap technology stocks. This is an interesting chart that we saw. What it highlights is the largest companies in the S&P 500, their return, and then you can see on the left-hand side got a data plot of many companies with little to no return. And so if you look at the first quarter of 2023, roughly 15-20 stocks had a cumulative increase in value of about $2 trillion. And all of the rest of the stocks, 490 stocks, were only up about $200 billion. So NVIDIA, which many of you may know about, it's a leader in making the chips for artificial intelligence. That was the #1 performer. But companies like Meta and Tesla and Amazon and Microsoft that had very, very poor results in 2022 have rallied. These stocks are still well below their all-time highs, but in the first quarter, we had a big rally. Most of this driven by large layoffs. We have seen significant number of layoffs at these big companies, tens of thousands of employees. And so now there's this focus on more near-term profitability at the sacrifice of long-term growth. And so in the first quarter, the market rewarded that. As Nick just mentioned, the second quarter, we've seen value do much better and growth sell off a little bit. So it'll be interesting to track this phenomenon and see how much longer these companies continue to focus on near-term profitability. And then this chart shows kind of the changing dynamics of earnings forecast. So this data is put together by FactSet. And coming into 2023, the expectations of the first quarter would be a little weak in earnings. Most of the guidance was prior earnings would be down 2 to 3% year over year. That number has now increased. So we've seen decreased earnings guidance from companies. As of this week, the Q1 estimated total earnings for the S&P are supposed to be down about 6.2%. So it's kind of stayed in that -6 to 7. So less earnings than originally forecasted for the year. So far, about 18% of the S&P 500 companies have actually reported their 1Q results, and they're a little bit better. So 76% have had a modest earnings surprise, doing a little better than people thought. And about 63% of the companies report a little bit better overall revenue. So it's this tug of war between the expectations. And once again, what's going to drive the market in 2023 is the Fed action and what really happens with earnings. But in aggregate, the earnings picture has become a little bit more negative in 2023. And that's kind of highlighted in this chart today. Okay, and then kind of quick summary. We have completed final due diligence on an income-focused semi-liquid private credit strategy. We're going to be discussing that new manager with all of you as part of our normal quarterly review cycle. We're very excited about them. We think they're a great complement to the 2 core managers that we use today. And this is a very easy strategy to execute. So we'll be discussing that manager, their strategy, and the specific allocation and client accounts. We're very excited to announce that we have a new team member joining us in Florida on May 1st. He'll be working directly in our Jupiter, Florida office, and we'll have an expanded role in the firm. So we're very excited, and we'll be making a press announcement on May 1st when he joins the team. Deb Hodge, who joined our firm last year, her role is expanding as our operations manager. She's taken on more and more responsibilities at the company. And so I want to make sure you're aware of Deb, and she'll be more involved in the company. And I think many of you will enjoy having the chance to get to know her. And then finally, our Orion client portal, which we launched last year. We received a lot of positive feedback from clients on that. If you've not done so yet, you need to create a login. We created one and sent out a temporary password, but if you've not yet created your full user, just reach out to us. We send you a new link and it allows you to immediately get access to your account. So we think that's a great new addition, and we're going to add more and more capabilities to the portal, but we're hoping more of you continue to use it. So with that, we're going to finish up our webcast. Once again, we're looking, I know we've met with many of you already in person. We're looking forward to seeing the rest of you as we complete this quarter of the cycle. And if there's any specific questions you have, reach out to Nick or me. And once again, Matt will be returning next week. And we look forward to seeing you again soon. Thanks so much for your time today.
Thank you, everybody.